Throughout the soaring market of the 1920s, the Republican Party stayed in power on the back of America's increasing prosperity. Calvin Coolidge became president in 1923. An investor himself, he was notably silent on the speculative mania gripping Wall Street.
Calvin Coolidge typifies the laissez-faire, devil-may-care recklessness of the 1920s. He's famous for saying that the business of America is business.
It was a prosperous period. Business was making money. Wall Street was making money. The politicians, I think, just said, well, everything's fine. The economy's growing. The market takes care of things pretty well, and the government's job is to get out of the way.
During the Coolidge presidency, Wall Street's power continued to grow unchecked. His administration had close links with an elite group of bankers and financiers, Wall Street's inner circle. Their wealth and connections gave them immense influence over the government's financial policy.
They were small, elite, private partnerships. This was really the royalty of Wall Street. These were very mysterious and discreet places. They were small firms with limited capital, but they exercised really an outsized power.
The most prestigious of these elite firms was the J.P. Morgan Bank. Strategically located directly opposite the stock exchange, it would play a key role in events to come. As senior partner at J.P. Morgan, Thomas Lamont was the most powerful man on Wall Street. His influence extended well beyond New York. Lamont and the other J.P. Morgan partners spoke regularly with successive presidents.
Grandfather was a very, very busy man. He didn't have time, as some grandfathers might, to take his grandson to the baseball game or go fishing and do things like that. Grandfather's lifestyle was certainly a very handsome lifestyle, there's no question about it. He did have his yacht, the Rennet, which was a 72-foot, very handsome yacht, which he often would cruise down from his house in Palisades, commuting by boat, if you will, down the Hudson River to Wall Street and then walk up to the bank.
Under Lamont's leadership, J.P. Morgan steered clear of the worst excesses of the stock market. But the close relationship between elite bankers and politicians helped keep government regulation of Wall Street to a minimum. While amateur speculators were transfixed by the soaring value of their investments, they were hopelessly unaware of how Wall Street really worked. With little government supervision, the market was a law unto itself, and insider dealing was rife.
There was a lot of market manipulation going on. It was rampant. There was no disclosure at all to speak of. And when Wall Street was very small and very self-contained, that was probably okay. But as people like you and me began to put our hard-earned money into the market, then it really mattered.
The stock market of the 1920s was neither fair nor democratic. It was a big gambling casino, and it was rigged by professional speculators.
As smaller investors gambled with their life savings, they failed to realize that the odds were stacked against them. Men like Joseph Kennedy did not make their fortunes by simply picking the right stocks. The truth was that they were cashing in on the naivety of gullible newcomers.
A bunch of sharp speculators would get together. In coordinated fashion, they would start quietly but relentlessly buying an individual stock.
What they would do is hype up a particular stock, buy it up themselves, and then dump it on the market so that they took the profits while the average investor in those stocks were left with the losings.
Even some of the elite investment houses on Wall Street were engaged in this type of market manipulation.
In March of 1929, a new Republican president, Herbert Hoover, was inaugurated. In his address, he reassured Americans.
We have reached a higher degree of comfort and security than ever existed before in the history of the world.
But behind the scenes, he was less confident.
Hoover is actually skeptical about what's going on Wall Street and the economy generally. But he doesn't have the political courage of his convictions. And so when he becomes president, he does nothing to rein in this wild speculative fervor. He doesn't do anything to encourage the Federal Reserve or the Treasury to tighten up margin speculation in the stock market.
Hoover was president, and he and Andrew Mellon, the Secretary of the Treasury, were way to the right and felt that it was not the government's job to interfere with this. They believed in pure, unfettered capitalism, and so they did very little or nothing to alleviate the crash. They said it'll solve itself. The market broke very sharply, and a lot of people were wiped out with it. It was very painful. Almost everybody lost money, as has happened now.